Okay, it says I'm live. In theory, I've got 2 minutes, but this way you guys could get a good seat if you're here early. Now I'm just gonna do that for a second so I can do all this other stuff. My AM time management could use some improvement. Good morning. Okay, we got some people here. Let me get the discount codes and all that stuff in here. I need back-end admin. Okay, so what I'm doing now is I'm just putting in the various links. It's a options depth discount link. It's a mentor Q discount link. Here's my Substack link. Okay. And eventually I'll be doing abbreviated version of the daily plan uh, live on YouTube, and then I'll kind of cut out at a certain time and continue for paid subscribers, etc. Also for updates. For now, we're just doing it all gratis, and of course, once in a while, I'll be doing it for everybody gratis, especially if crap is hitting the fan. I can't subscribe. I don't understand. What do you mean you can't subscribe paid on Substack? What can't you subscribe to? Okay, 831. Um, DM me in Substack if you can't subscribe to my account. Not sure why not. I'll have to figure that out. Let me take a screenshot of that, and I'll have somebody remind me to take a look at that. Hold on. My BFF Nanda helps me with the back end stuff. Okay, enough of that stuff. I'll make sure I straighten things out. Okay, so let's see where we are. Now let's first start off. Here's my levels. That's in the trading view from the stuff that I just write up my note. I don't know why I got the why they're kind of off to the why they're not offset enough. So here, let's start off with with some context. So Wednesday, as a reminder, CPI came in soft pre-market after the print volatility reset. We popped out to 60, 70 right at the straddle high. Then we kind of chopped around the 50 level. Then we got that then we started just kind of playing in that 30 to 50 zone that we'd been in for quite a while. Oh, that's better. That's what the problem is. I had a little scrunched up. We started hanging around in here. Then we got then we had some little bond auction wiggles. Then we had the account deficit, and suddenly inflation became the story. Then we had war in the Mideast, and that became the story. And here we are back at 6,000. Yesterday, 6,000 held, and then we had the charm decay shove us up to the 60.22 ish, wherever it was that we closed. Oh, well, I'm a little, my timing is off, okay. Yeah, we bottomed out right like when the peak news hit 230, and then we there was like some big strikes that people noticed. The 60-10 puts were bought, and the 60-20, I think there were customer long puts there. And if they're in the money, market makers have to sell to flatten out their delta. If they decay to out of the money, they have to buy. We got that big charm whoosh at the end of the day up to 60-20. Good morning. You can't get it. Okay. Mohammed, please DM me and we'll take care of that. I'm serious. I want to make sure that you have access to everything. And here we are back at 6,000. Now, 6,000 in the zero DTE, just strictly speaking, doesn't have quite the strong, doesn't present quite the strong level as it had been just in terms of the options positioning. We're going to get there in a minute. Let's just pull up the mental queue. Let's look at the intraday model. And this is just a nice, easy way to see the levels, especially if you like to sell spreads or whatever. Sell down here somewhere, sell up here somewhere. But let me caveat, if you're not an experienced option seller, and or if you sell iron condors as one unit, days like this where you have the volatility jacked and we had this sharp reversal, we could see a pop in our faces pretty good. As this stuff decays down here, and we'll look at the actual positioning, May PPI revised, whatever. So be careful selling calls early. I don't sell iron condors as a unit. I leg in each side separately. Once in blue moon, I might sell them as a unit, maybe one contract each, just as what I call a range finder to see what the premiums are. And so that's where we are. Also, what happened yesterday. So let's look at VIX real quick because I think this is potentially important. I'm not a VIXologist. I'm a VIX tourist. You got a lot of guys that are fancier with VIX than I am, but I think I got a somewhat of a perspective on it. And so let me kill the noise. And so VIX, we've been kind of trapped in this sub 17, 17 and a half range, and we have market makers are long VIX puts into the June options expiration. So this 17, 18, these become inflection points where the puts and calls are in the money or out of the money. The puts are really dominating. So that's going to be what's going to kind of flip the script for the June. Remember, though, that this is July. VIX is roughly 30 days, a strip of options. So here's what's being priced in for July. So the hedging for that for the June is not quite the same. If the VIX 9-day updated, I would have a better way of showing you that. But let's look at VVIX for a second. So VVIX, the jobless claims gets posted at 8:30. Reason for a little volume spike in price wiggle. Okay, so thank you, Brad. And so the the destruction of Iran is on the back table because the jobs data was good. Okay, that's makes sense. Don't worry. In 10 minutes, we'll have another headline. As you can see, the algos are really just kind of running the show here. So I want to talk a little bit about something obscure, maybe, that I mentioned to people in the note. That's the same note that went out to everybody and was on Twitter and everywhere. And that's the VIX VVIX ratio, the VVIX VIX ratio. So VVIX is the demand for VIX options. Just like VIX is calculated on a strip of VIX um, uh, of S&P options, roughly 30 days out. There's actually a formula, different weightings of different parts of the strips. The VVIX does the same thing for the VIX. Same calculation ish, I think. I think it's the same method, only for the VIX options. So this is demand for VIX options. Puts, calls, doesn't matter. But of course, with VIX, it's calls. And so VVIX spiked to 105. So there was heavy call buying, um, VIX call buying as a hedge against potential Armageddon. More and more VIX calls or VIX options are being used by institutions and retail like me to hedge rather than SPX puts. Not saying that they dominate, but more and more. And I'll tell you why that is from where I sit, from the cheap seats. If I think there's going to be an event, let's just say one of the things that I'm thinking is that after um, after next Wednesday, FOMC and VIX expiration, we could have a possible unclench, and then on June 30th, the end of the month, the 5900.05 JPM calls that they're short, that's supplying the market makers with this backflow of positive gamma support near that level, go away. So if that happens and we drop whatever it is, we have a 2-3% drop in a week. I don't know if SPX is going to be at 6,000, 6150, 5910. I don't know what that level is going to be. But I do kind of know that when that happens, VIX is going to pop. So I would rather buy whatever it is, a VIX call debit spread. I like VIX call ratios where I buy one or sell two, or a VIX fly or something like that as a way to express it. So I don't have to get the S&P level right. I just have to get right the fact that there's going to be a reaction. And I'm not the only guy in town that does that. So with that said, long-winded way of saying, and we'll get to the nitty-gritty of the daily plan in a minute. There's this ratio, the VVIX-VIX ratio. Just divide one into the other. Simple math. And the ratio came out to 5.4-ish. There's a normal range, depending on whose secret sauce you want to look at, of about 5 to 7 or 8, 5 to 7-ish. 5-ish is market is hedged and cautious, waiting for the other shoe to drop. And 7 or 8 is market is buying calls and not really worried. And you better be careful. Maybe time to buy VIX spreads. And in February, when we were at the all-time highs, that ratio was around 7. That was kumbaya, nobody's worried. Buy insurance when you can, not when you must. In April, when we were tanking, that ratio got to like 3. Way overdone. Like, I think it was even higher than in COVID. It was historic. It was nuts. And then, like I said in my note, what does this level imply, 5.4? It implies either overdone and we get a whoosh, or there's real big trouble brewing. We don't know. That's where our gamma analysis, our macro, however it is that you use to make sense of the market comes in. However it is that you try to get your bias. Okay, enough said about that. Um, so we closed at, let's get back to the S&P 500. I got time. I'm going to jump off at around, and some people sometimes ask me how I get the S&P moving during real time, during like, excuse me, when the market is closed. There's this thing on TradingView called SpreadX. If you type in S&P 500, whatever it is, SPX, and start typing SpreadX, that comes in. Okay, so let's just pull up a chart here so we have some levels, some lines, and we can see where we are. Okay, so we're back above 6,000. The overnight range was, let me look at my notes here. The overnight range was roughly, I always round off my numbers, by the way. I'm not a 60, 22.39 guy. I round them off. Some TA people are precise. They'll enter to the penny or to the dollar. That ain't me. Um, Part of my Zen. So the 59, 85, 60, 25 was basically the overnight range. And here we are kind of in the middle of the range. And as things turn out, that where we bottomed out during the day, during the overnight session, is kind of where I see the bottom of the chop zone for today. When I looked at the levels. Oops, let's look at this one. It's cleaner. I have one that I made for myself with every tiny little minutia in it. And I have one that I made for subscribers that's just kind of a little cleaner. And so, we got this right here, and have that in the plan. So let's see where these levels come from. So, so the middle of the chop zone, and we'll look at options depth, and we'll see how I came up with this. There's kind of three zones that we could dance around in. The 90-15 zone is one. If we can get over here, that 15 to 30, where we spent a lot of time lately trying to get over that. We finally closed at 34 or 38, was it, the other day? Can't get over 50. We got over 59.50 on that CPI thing and quickly got slammed below it. And we kind of tried, we teased it, we tried to get over it, and we kind of couldn't. Got some other ranges. So the straddle, the weekly straddle. So last Friday I took the straddle price, and the weekly straddle, and I got it right here. Here's the weekly straddle. Here's exactly what it is. If you must know, you can write it down. 5907.73 was the bottom, and 60.92.99 is the top of the straddle as of last week. And market makers, institutions kind of mark that and keep track of it. There's a lot of vol selling and whatever related to the straddle, realized versus implied volatility, etc. Interestingly enough, yesterday, despite all the craziness, the straddle, the 60-30 straddle before the number, I think it was about $40. So if you sold the straddle for $40 and we closed at 60.22, you got 40, cost you 12, you made 28 or whatever it was. Let's call it 25 because you bought wings because you didn't sell the straddle. You bought an iron butterfly or something. And so these things are remarkably resilient. They're just remarkably resilient. I like to be cynical and say they don't know what they're doing, but apparently they're pretty resilient. How did I get that? I got that indicator from TheoTrade, I think. Um, if you subscribe to me, I'll find a way to get it to you, or DM me somewhere. I'll see if I can figure out how to get it to you. I'm not that fancy. TheoTrade had it in their free resources once upon a time, buried somewhere under indicators. So if you want to go to theotrade.com, they have all kinds of stuff. I tried subscribing once. Meh, listen, I was very unimpressed. Let me just put it that way. Um, but they had some good indicators in there. That was one of them. They have a lot of TA stuff, and when I was a neophyte, I tried all the TA stuff and Voodoo, whatever, and I found that a few things worked for me. I had two official TA mentors with like paid mentorship and all that kind of thing, and there was some value in that. And I've had more paid and unpaid Gamma mentors. I find a lot more value in that. Anyway, back to where we are, because you don't want my story. You want to know how to make money. So let's figure out how we're going to make some money today. So for that, I got to go to the MRI of the market, and that's options depth. If you trade futures, if you trade individual equities, mentor Q is great, Gamma Edge is great, Spot Gamma, all of them have some good stuff. If you trade SPX, for me, options depth is a gold standard for SPX. And I'm kind of more and more one trick pony, although I do get all of them because I do trade other stuff too. And in the future, there'll be some individual equity kind of trades and some set it and forget it kind of credit trades like straddles or strangles or put credit spreads or iron condors, 3 trades a week with mechanical stops, whatever, old school stuff, covered calls for people who just want to do something. All that stuff is coming. So here's the structure. Anyway, so what my old TA mentor used to call this, because let's pretend that these are red and green bars on a price chart. He used to call it a frog in a blender. Here's where you get all chopped up. And why do you get all chopped up? Let's get started from where are we now? We're 5,900, so excuse me, 6,000-ish. So we have this fly-looking structure right here with the center at 05. Not perfect fly, but so market makers have to buy as we come down, trace up into here, market makers short. Now these aren't big numbers, and then stall over here, and then buy if we get over here, and then stall here, buy here. So it's just a choppy, sloppy mess. Below 6,000, that's why in my note I say below 6,000, we could accelerate to 5,990, where we kind of been topping out because we have this double strike right here of 95 and 90, market maker short, customer long. So, if this breaks, we could pull down here. However, market makers sell on the way up and buy on the way down. So we have this zone between 80 and 6,000, this 20-point zone of choppy action. Okay, something just changed. So positioning might have changed. This updates positioning. Somebody closed something. This updates positioning from the CBOE every 10 minutes. And why is it every 10 minutes, not every second? Because you can't buy every second. Your money's no good. Maybe Warren Buffett could buy it. I don't know, but you and me can't, and neither can any of these services. Okay, so that's what's going on here. And we have this short customer short dealer long gamma over here at 56.65. So that should quote unquote be okay, but then down here below that we have a void. And we have this big magnet all the way down here, should this break. And then all my buddies, the vol sellers, me included, sold all this crap down here yesterday as we were tanking. And to the top side, there's not a lot. People sold, where you would expect 75 and higher. Up here, my buddy Jake, he's not here now, was selling these yesterday. And so that's what we're looking at here in the S&P 500. Now, this heat map takes everything into account, and we're going to look at charm a little bit. Oh, by the way, if there's questions, just put them in the chat. I always like, I want to know my Nielsen ratings. If people can just tell me how many people are watching on Twitter or on YouTube or where you're watching and put it in the chat, I appreciate it. I'm still not sure if when I tweet it out, who's seeing it, who's not, whatever it is. I am not the techie. I'm a 72-year-old man, as I often say, and so this is a brave new world. I'm figuring this out as we go along. Okay, so I'm not sure if I have this set to gamma. At some point, we'll do something that's set to gamma. That's why it's giving that bigger bar. So position number is just going to tell us how many are there. Gamma is going to tell us how strong the impact is at this time. Gamma being dependent on price, how close we are to it, and the time to expiration. Whereas position number, that stays there. So these positions up here, for example, or down here, might not have a lot of gamma, but if we get down there, they sure as heck will. Or if we get up here, they sure as heck will. But their positions, I like to know where the action is. Why do we sell on the direction of the move? Okay, without going into lengthy explanation on that, just if the market makers are short an option, as we go toward their short option, they are too long, so they have to sell to be delta neutral. As we move away, now they're too short and they have to buy. That's the positive gamma environment. And so that's why it becomes sticky, drifty, and you drift up and down. You get mean reverting chop, and you kind of break through levels and retreat into them. Does that make sense? So in general, market makers are providing liquidity, cushioning the moves in either direction is another way people like to think about it. When market makers are short, market makers, let's just say again, hypothetically, market makers are, well, not hypothetically, actually, market makers are short here at 60.05. They are competing with you to buy them. And so it exaggerates the move. It widens out the volatility curve in the big ax spread, and they're actually in there buying futures. They're not competing with you for the options. They're already short those options. They're buying futures to hedge their short exposure. And so you have the futures buying. This is all because the hedging is done in futures, and that's what happens. Does that answer your question, LJ? Let me put the question that I was trying to answer. And 31 on YouTube, 342 on X. Yay, me. Okay. And actually, I'm going to have Volsigs, Carson, the former market maker who worked for whoever he worked for, he never disclosed who he worked for at some point in his career. He used to train the newbie market makers, and he can tell his own story, but he sort of got bored with how mechanical it was. He likes the more creative part of it. And anyway, here he is teaching us stuff and making money and imparting his experience, strength, and hope to us. So did that explain it, LJ? But he'll be explaining it, and other people can come up and explain it. He'll give you the chapter and verse of all the Greek math, but that's kind of the sense of it. It's basically about being delta neutral. Did that explain it, LJ? I don't want to blow you off. Sort of. Okay, ask on Substack. Good. Okay. And I think I have a PDF somewhere. And so let's get to Charm real quick. And it's almost 9 o'clock, so I'm going to sign off in a minute. Okay, so Charm is what's going to happen as the deltas that the market makers have in their book decay. So it's kind of the opposite of gamma in a way, or another way you can look at it, it's the opposite of volatility, of time. As time passes, volatility is the standard deviation of the expected move over time. As time passes, the expected move gets less. The delta gets less. That gets plugged into the Black-Scholes equation, and that's a nice way of thinking of it. And so as these deltas erode, let's just take the 6,000 as an example. If these 6,000, and let's just pretend they're long puts just to keep it simple, and we're around 6,000 and they're 50 delta. If we're 59.99 coming into the close, those become a -1 delta, market makers have to hedge. If we're above it, they become a 0 delta, they have to buy, and then they have to balance out what they're long and short, and then we get to the next level. And that's kind of where the end of the day. Now notice that here, the heat map is meh, the colors aren't saying anything because there's the hedging pressure from Charm, just from the decay, there's different Greeks going on simultaneously, is not as strong at 10 o'clock as it is at 3 o'clock, power hour. At power hour, if we're at 59.90, there's going to be a lot of hedging has to be done. Earlier in the day at 10 o'clock, not much. If we're down here at 59.20, OMG, here there's not going to be any hedging related to that, to the decay of that. And that's basically it. Now, I'm just going to, okay, hold on 1 second. Not investment advice. I'm setting up my own, I guess I've taken to setting up one trade that I call my wish trade. That is one of the things that I do. And sometimes they get filled, sometimes they don't. I usually just do one of them. So if it turns out that I don't want my wish granted, that I have lots of ways out of it. Can you still hear me? Yeah. Okay. It said PC disconnected, but apparently the PC is connected. Okay. Now this is like a kind of broken wing fly structure I did yesterday. I'm not worried about this. Let's just kind of ignore it. That's fine. But let's look at what I would do today. So for right now, remember I said 35? Let's go over here. I'm just thinking out loud. When I trade next to people in the Discord or whatever, we think, okay. So here's that. Okay, we have this big void over here. So if this shit breaks, pardon my French, probably not getting there, but we could. So that's not the best spot to be, but we have the 65 blocking us. That's way outside the expected move. And we have all this stuff down here. So ideally, if I could sell down here and steal, I'd be happy to do that. So 59.20, let's just go the old school 20 wide, 45 cents. If they give it to me, I'll take it. Yes, that's a lot of money for margin, blah, blah, blah. If you like selling tight 5 wide, there's nothing wrong with that. Nobody's going to shoot you. 5 or 10 wide. A 10 wide might be something like maybe 35.25 for 40 cents. That's not good. 10 wide. Maybe you want to do a 50 something like that. So the vol is already drying up here. So I would look to sell in here, looking at where we are, expected move of 36, and where are we? We're at 60.15. Okay, we're back at the top of that mid chop zone. So news of my death has been greatly exaggerated, as Mark Twain says. Let me get rid of that. So now, what would I do? I'd probably do something in here. What's a 45? Oh, it's 90 cents. That's not bad. So I'll go into the 35. 35.15, 50 cents. I'll throw one of them in for fun. Top side is tricky. Now, I did a trade this morning. When I put it in my note. The put call skew, when I looked at the 20 delta put and call in ES, there was like $1 difference. So I sold puts and bought calls in ES for 0 DTE. I did a spread, did it for a credit, and either I'm right or I'm wrong. So 70 was the high yesterday. Are we willing to challenge that? Sure, why not? And apparently I sold this yesterday. I probably don't have to worry about getting the 61 the 6120. It's probably going to be okay. Well, and I see the working order that I just sent in. 70, 85. I want at least 40 cents. Oh, that's because I'm looking at the wrong place. I sent it into the wrong place. That's okay. I have two accounts here. One's my retirement account, and one's okay. I'm not really worried about that, but it is kind of a tad cavalier. And here's just a fly that I have centered for July that I did a while back. It was cheap, like less than $2. Centered on the 5,900 where the JP Morgan strike is. Should we kind of pin back down into there after after July, after the end of the month, June? Okay, I'm done. I'm going to Valsig's. The teacher becomes a student and see what he says. Okay, take care, everybody. Have a great day.